the day I got my policy document, the kind of comfort that I felt that if something happens to me, my family will not suffer financially. I have never felt like that ever. Even after seeing 90% returns annually from the stock market, or seeing my corpus hit that financial freedom levels. No, nothing can replace that sense of relief that I have. So
we're in week 3 of Get Rich with Pattu. The main man is in the house. Pattu, how are you doing?
Doing great, thank you.
All right, we're going to dive straight into a question. No introduction, no googly question. I might have one at the end, Pattu, for you. It might get a little personal, and you can tell me to shut up and not answer it. It's your choice. But getting to today's question, here it is. Should I invest in insurance plans, products, or in fixed deposits? All right. I want to continue this question with a personal story, Pattu, from probably when I was in my early 20s, not so long ago, by the way. I remember this scene very clearly. We were sitting around the dining table at home, my mum, my dad, and somebody they trusted a lot who happened to be an insurance salesman, right? They knew him. He was the one who gave them their medical insurance. I had just started earning, right? It was a new phase of my life where I kind of felt responsible. What should I do with my money? And in those days, the number one thing was about saving tax. And so you invest your money in particular places, you save some tax. And then this endowment plan was proposed. Let's not name the brand because, I mean, all brands do the same thing, right? These products which are endowment plans, which suppose something happens down the years, this is the amount of money that your parents will get. And the nominees were my parents. There was something about, there is something called, what was the term they used? It was something like sum assured. That's the term they used. This is the sum assured. But I said, are you sure you can assure it? No, it actually depends on market. If the markets go up, you get more. If the markets go down, you get less. And for some reason, of course, I was a complete novice. I said yes and paid the insurance. It was a yearly one-time payment. And then I paid it the second year and I paid it the third year. This continued for 5 or 6 years. And slowly I was getting wiser about how things worked, etc., etc. What I actually did after the end of 6 or 7 years, I'll reveal at the end of the episode. But over to you, Pattu. I speak too much, as usual. How do you answer this question? Insurance products or FDs?
I would say this is a wrong question to ask, first of all. And I would say the person who's asked this question should first not worry about products and worry about what is it that he or she is aiming to do. Because like we talked about in the first episode, a recurring deposit or a fixed deposit is a savings product. And that is a very good option for those who have a short-term need. So they want to go on a holiday after 1 year, 2 years, they want to buy a bike, mobile phone, laptop, whatever. Then they can start an RD or an FD depending on their cash flow. They have a small amount with them, they can start a fixed deposit. If they want to take it away from their salary every month, a small slice, they can start a recurring deposit. So that's how the deposits work. So they are good for short-term needs, but not for anything else. Now, insurance products, I would say the only insurance product that we must invest in is a pure term life insurance product.
Amazing.
And
I feel so
else.
good to be. I feel so good to be right sometimes when Pattu reinforces what I believed in for a few years.
And I call the term insurance as an investment, although many people will not, because it is an investment that guarantees my peace of mind and the welfare of my family, my loved ones, in case I'm not able to. In case I die and they have to fend for themselves. So that is an investment that guarantees me this peace of mind, and therefore I view pure term life insurance also as an investment. However, there are also a multitude of other investment products which give you something back. People always want something back. And they ask me, if I invest in this insurance product, what will I get? So
exactly. So let me interrupt you there, Pattu, very quickly. So what a pure term plan is, when you pay the insurance, or when you pay the insurance premium every single year, whatever amount it is, you don't get a single rupee back ever. The only time when it pays out is when unfortunately you lose your life and your next of kin or your nominee gets the entire insured amount, which is a huge sum, right? And I get my own colleagues, my own classmates who are much more educated than me, or at least as well educated as me, who say, why do pure term plan? You get nothing back. And that's what Patu's talking about. So how do you counter that very strong, cemented mindset in our country?
So what you just described is what is now called as a plain vanilla term insurance plan, because now people, the insurers have got intelligent. They know that people will buy an insurance product only if they get something back. So they have now come up with term life insurance product with return of premium, or with a limited premium payment window and so on. But I would say avoid all of that because they are a lot more expensive, and just buy a simple term insurance product where, like you said, you get nothing back if you outlive the policy. And if you don't outlive the policy, your nominees will get the sum insured. Now, of course, people are always going to ask, why should I invest in this? Because I get nothing. But like I said, I felt wonderful when I actually purchased my term insurance policy. I got it about 12 years ago. It's a very expensive policy. My 60 lakh cover from LIC cost me a whopping 36 K a year, because at that time I was obese and I had a high blood pressure. So they loaded the premium for that. I know in those days there was just only one online player. Today we have everybody selling online term insurance. But that the day I got my policy document, the kind of comfort that I felt, that if something happens to me, my family will not suffer financially. I have never felt like that ever. Even after seeing 90% returns annually from the stock market, or seeing my corpus hit that financial freedom levels. No, nothing can replace that sense of relief that I have. So, like I said, you are paying for that sense of relief, and it would be irresponsible to assume that I can just buy myself an endowment policy or any kind of ULIP or something for a very small premium, and where the sum insured is just a fraction of what is actually required, and you feel comfortable with that. That's not possible. So I would say the responsible thing to do is buy yourself that at least 1 crore term insurance plan, which everybody does, and you have to buy it and get the policy document in your hand to imagine what the joy you get.
It is. I truly understand what you're talking about. I had not bought pure term insurance until I had my first child, which was also quite late, right? And that's when you really feel that sense of, it's almost like a sense of accomplishment, not only relief, but it was a sense of accomplishment that
Absolutely.
I've taken the right decision, and I've done the right thing for my kids, etc., etc. It's a great feeling. And of course, it was expensive when I did it as well. So take Pattu's hint, take my hint, do it while you're healthy, do it while you're young, do it for the people you love, and try and get that feeling, right? I know this is a podcast about money, but money can also make you feel really good, and you must experience that feeling. Getting back to the topic, we love segueing right away from the topic. So you said no insurance products and no FDs until you know what the purpose is.
Absolutely.
My question is now going to start going to the territory of controversial, etc., etc. Why are these products allowed? Why does the government allow such products which really don't do much for you on either end, as investment or as insurance?
I would say every product has got problems, not just endowment policies. I would say mutual funds also have problems. In fact, we have seen a huge increase in the number of mutual fund investors in the last 5-6 years. But many of them invest with a wrong perception in mind. They believe that they will get huge returns by just remaining invested in a mutual fund, doing an SIP. That's a flawed perception. So I would say there's nothing different between a guy who buys a endowment plan without reading its terms and conditions, without understanding the impact of buying that over the next 10 years. What is the return it's going to offer? What is the inflation of my need? and the investor putting money into stocks or mutual funds, assuming huge returns just by staying invested. So I would say all products have this problem. The solution is only financial literacy. The solution is only when we um, learn to respect our hard-earned money. So many of us don't do that. That's my feeling. We have to take some time to read the terms and conditions and understand whether this product is actually suitable for my need. If people bothered to do that, they would know that the endowment plans offer anywhere between 3%, 4%, 5% returns, and the actual realistic inflation in India is like 7, 8% approximately, and that is during a good time when the repo rates are low, and the cost inflation index is low. And now it will be a lot more higher. So this means that when you buy an endowment plan, you're constantly losing the value of money over time. Although you know that the insurer is going to say you bought it for those nice worth, guaranteed returns, assured some bonuses, and so on. But the value is going to erode with time, and you're going to be left poorer than what you were when you actually purchased the policy. So the reason why people don't appreciate that is they don't do the research, and so they get what they deserve, I would say.
And that's exactly why we're doing this, Pattu. We came up with this idea when Rajesh from the team said, listen, we have to do something with Pattu, who's doing the right thing and saying the right thing on YouTube. Let's do a podcast. And we very sheepishly and shyly and nervously called you up. And within 3 seconds, you said yes. And within a week, we were recording. And I hope this positively affects so many people. Coming back to my personal experience, right? So 6 years, I paid this premium of an endowment plan with some piddly sum assured, etc., etc. I stopped paying the premium. I literally stopped, and it went up into something called paid up. I don't know if you're aware about this, Pattu, but it goes up into paid up. And hopefully at the end of this 25 years, I might get some small amount. I'm waiting with bated breath for that amount. So if anyone's stuck in such insurance combined schemes or products that give you insurance and give you some kind of growth of money as well, I would go to the extent of saying, yes, consult a financial consultant if you have to. I must be legally sound with my advice as well, but stop it and let it go into paid up and do something better with your money. Do you support that view, Pattu?
I would say yes, because whether you're making it a paid up policy or you're going to surrender the policy, you're going to stop premiums either way. That is the most important thing. And paid up or surrender is basically that depends on the kind of loss perception a person has. And when you tell a person to surrender a policy, they ask how much will I get, and they're going to get about 1/3 of what was assured to them, and they say, "Oh, that's a loss." I tell them, "Look, that's a loss, but if you're going to take this premium and put it into a mutual fund, after a few years, you're going to gain or lose that sum assured every day in the markets, right? Because of your wealth is going to grow. So you must understand that this is just think of it just as that market volatility." But people don't accept that, so they would like to make it paid up. So I would say it's fine, whatever, but stop paying premiums.
Absolutely, and cut your losses. It is ironically, Pattu, and we're not perfectly sure about this fact, but it could be a fact that this is the number 2 selling financial product in India, which is these endowment, these combination plans which combine insurance and growth of your money after fixed deposits. And that's scary to know. But yes, on that note, that brings us to the end of yet another episode of comparing insurance products with FDs. Pattu says, don't do either unless you know exactly what your aim is. Get yourself financially literate. Keep listening to Get Rich with Pattu. And keep sending in your questions, without which we cannot do this show. Pattu, any last words?
I would say learn more about inflation, because that is the key driver. And I would also say when we talk about get rich, but what does getting rich mean? I would say the first start by having a mindset that I am going to be a crorepati in the next 10 years. I'm going to have tens of crores in the next 20 years. Have a long-term vision and start building towards that long-term vision, and the rest will follow.
I realize I've called an end to this episode, but I still had a couple of questions left. So, this show goes as it flows, and I'm going to ask those questions part two if you don't mind, and if you have a little more time, right?
No worries. Yeah.
If somebody wants FDs or insurance plans because they are low risk, what would you recommend apart from them for any other low risk appetite person?
I would say first evaluate your risk appetite and understand what you actually mean by low risk. So there is
Paisa
no
guaranteed chahiye.
Yeah. So that unfortunately is the biggest risk we take, and that propels us to make biggest investing mistakes. That we want something assured, but we neglect the fact that inflation is constantly eroding into this assured sum, and we're going to be left poorer than what excuse me than what we were when we started the investment. So that's the reason why I keep saying track the expenses that you have. What were your expenses 2 years ago, 3 years ago, 5 years ago, and look at how it has increased with inflation, and that will tell you if you project it out into the future, how much your how much money you need in future, and what is your benchmark return for your overall portfolio. So the benchmark return should be after tax at least equal to, according to current inflation estimates, I would say at least 8%. That's for overall portfolio, everything included. And clearly, if you buy something that's endowment with a guaranteed or assured tag on it, you're going to get much, much less. And the only way you're going to make up is by investing a lot more. But very few of us have a lot more to spare. So it's a no-brainer that you should not buy this.
Very interesting question that's come into my mind when you mentioned that 8% at least, right? So just yesterday, I was arguing with my parents. We've had this sum of money, which belongs to my mum, and we've been debating for the last few months what to do with it. And the last few months, and if you're listening to this in April of 2023, have been very sideways, right? There's been no growth, whether it's SIPs, whether it's mutual funds, etc., etc. And now the bank people are really calling them up and hounding them and saying senior citizens ko 7.2% mil raha hai. And it is less than that 8%, but it's much better than what's happening in the equity markets right now. And so we are on the verge of putting a large chunk of money back into fixed deposits, which I had to battle with them for 3 years to take out of. So it's a very interesting scenario in my own family.
See, the circumstances are different there. So we are now everything that we have said so far is for a young earner.
Absolutely. Yes, I'm sorry.
Yeah. So for a senior citizen or for somebody who is close to becoming one, a fixed deposit with a high interest rate makes sense.
Yeah.
Because most of them would not have capital market experience. They would not have gone through the ups and downs of the stock market. So any undulation in the market is going to cause them, stress. And whatever we do, there should not be stress in life. Absolutely. Or investing. So it makes sense.
Listen to your parents, guys. We also give life advice on this podcast apart from financial advice. All right. And the googly to end this episode with. And you can shut me down and say, no, I'm not answering this. And we'll call a very peaceful end to this episode. But part two, you on episode 1 said you started investing and within 8 years, you became financially independent, right? Financially free. And I can't wait to have that feeling. But that 8 years seems to be kind of unrealistic for our listeners, right? I mean, I personally would have to invest something like 5 lakh, 10 lakh per month for maybe 8 to 10 years to even achieve a number that kind of makes me somewhat financially free, right? And that's impossible. So what is a realistic timeline? And how did you do it in 8 years?
No. First of all, let me clarify what I mean by hitting the thresholds of financial independence. That's when you have a corpus of 30 times your annual expense for your retirement. So we can talk about why it's called 30 times and so on in another.
Absolutely. A very cool fact. I've never thought of that. 30 times your annual expenses. Nice.
Because it involves a little bit of math. So we'll get to that. But I want to clarify that each person's journey is unique. And in my case, it was a combination of two things. One is I have been investing a lot of money during the sideways market between 2009 to 2013, the 4 years when the market was not doing anything after the 2008 crash and recovery. And also during this time, it so happened my salary increased a lot due to different reasons, pay commissions, promotions, etc. And so I always had a frugal lifestyle. So I still
That's the
use
key, isn't it? Always.
I have never driven a car. I have never sat in the driver's seat of a car. I don't own a car. I have a smartphone, but my main phone is a feature phone, so I don't. My needs are very less. So I was able to invest a lot. Thankfully, the needs of my wife is also less. That also matters. You can't have two people with different temperament, then it's going to cause friction in the family. So it's a combination of different things. And 8 years is it's not a benchmark or a guideline or anything like that. It's a very personal thing. I would say what matters more is that have the belief that you can be financially free if you invest in a disciplined manner. That is the key to anything. Discipline is the key to doing anything substantial in life. And building wealth is more different. Let's take the guy who said she's earning 30K a month. If you go to her and say, when will you become a crorepati? She will say, I will never become a crorepati. That's the problem. You have to believe, you have to tell yourself, I will, with my disciplined investing, become a crorepati in 10 years, 12 years, whatever. That's a goal. Have the goal. It could take longer. Let it take longer. But you are going along that path, and that's what matters.
Beautiful. It's a topic which is all about numbers, about hard facts, and yet it always starts with belief. And on that note, believe in Pattu, believe in your future, believe that you will one day be financially independent. And we'll do it together here on Get Rich with Pattu. Thank you so much for listening. See you next week. Please send in your questions, Pattu. An absolute delight, as usual, to speak with you.
Thank you. Bye-bye.